wonderful moderating a panel of two very successful founders, Deena, Jacob and Ganesh. Very accomplished in terms of what they've done so far. And in addition, I think Deena is a local celebrity in Trivandrum, Kochi and all the towns in Kerala. So wonderful having both of you. So let me just start with, until the year 2022, a lot of easy capital was available. It was both a good thing and a bad thing. Good thing because it put the startup ecosystem on steroids. And several people were inspired to become entrepreneurs. And the bad thing was that several substandard and not well thought through ideas also got funded. So in the process, I think it ended up creating some myths in the startup system that I just want to explore with you. The first myth is that all startups and all businesses need VC money to grow and scale. So Ganesh, can I just start with you by asking you for your thoughts on this, as well as your views on what kind of businesses are best supported by VC capital and what kind of businesses can do without VC capital?
Yeah, thanks, and pleasure for me to be here with this August panel, and good afternoon to all of you. So I think one fundamental is that venture capital is high risk capital seeking high returns. They are not as distinct from a bank or as distinct from your father's or grandfather's provident fund money which he got when he retired from government. Those capital seek safety of return, safety of capital. They can't take risk. Therefore, their returns will be modest returns. Venture capital is completely the other extreme. So, if you are an entrepreneur, if you want to seek venture capital, be clear your venture is high risk and high return. If you go to a venture capitalist saying that I have a safe business, that's not going to excite him. And I don't want to go into details, but the venture capitalist business model works on betting in 10 high-risk companies, getting 2 high-risk companies to return the entire fund, losing money on 3 or 4 of the companies, balance barely able to get return. So point number 1, if your business is high-risk, high-return, then it's VCable. If it's low risk, by logic it will be moderate return, it is not VCable. So don't go there. That's the thing. Lifestyle businesses. Just as a simple example, I want to start a direct-to-consumer business. I want to invest in a brand. I want to start advertising, create a brand, compete with Hindustan Lever.
Capture or attract people when you are going with a new concept. But at the same time, there has to be a time and a point where the stress test stands. I mean, it stands the stress test, where the payment is enough to cover your expenses. Every sale is making you money. So that's when the product market fit comes, and then only go for scale, never before.
Great. Ganesh, would you have a point of view on this, or can I move to the next?
Yeah, so I mean, I have a very strong point of view on this, and we can spend the entire day on the point of view on this. But a short thing is, I think this is the product market fit. Whenever I hear the word, I almost cringe. Okay, right? This is really a jargon, if you are kind, or actually BS, if you really want to be very frank. Okay, right? The reason is simple. People, I mean, this used to be the traditional thing. You build a great product, people will automatically come. It never ever happens. There are a lot of myths around product market fit. First of all, product market fit is, yes, basically it's required, people need to love the product and all that. But that's only the minimum table stake. There are channel and product fit. There is business model and product fit. Unless the business model is clear, the number of great products which have failed to gain traction is very, very, very many. And the number of poor products, because they have very strong distribution or they have a monetization model which have succeeded spectacularly are also very many. I mean, you and I would know, Microsoft Word was not the best word processor. Word Perfect was best. Excel was not the best spreadsheet. Lotus 123 was the best spreadsheet. Microsoft Explorer was not the best. It was Netscape. That was the leader. So all these companies which I mentioned, which are no longer there, had great product market fit. They did not think about the other elements. The channel, the monetization model. Channel means distribution. Partners, what you want to do. So I think it's a full class on its own, but don't get carried away by product market fit. Look at it in totality. Look at channel product fit, channel company fit, the business model and product fit, and all the 3 or 4 fits together in totality before you double down and scale and grow your.
Awesome. I think, talk of Microsoft, probably none of their products were actually best in class.
Yeah, their distribution is so
distribution,
strong.
Yeah,
Yeah, just they bundled it. They bundled it with the operating system. They gave it free. They do that, and they wiped out the entire competition, which had perhaps the best product market fit ever possible.
Yeah, absolutely. So Ganesh, now just moving to the other myth in the ecosystem, which is growth. Growth is super important. Growth at any cost. Can you just talk a little bit about what kind of growth is good, what kind of growth is not good? How do you grow very sustainably? What are some principles behind building a sustainable growth? Your thoughts on that?
Yeah, so that is, it's very ironical that you had me. Half the time I have done growth, I have done bad growth. Okay, right? So I'm the wrong person to answer that. See, obviously, growth is important because in absence of anything else, companies get valued on growth, market share, multiples of revenue. So the reason we can all say that you have to grow profitably, you have to look at unit economics, you have to look at profitability. We can say all of that stuff. But when my investors, when the market, when my valuation depends on growth, okay, that is the only thing. And without growth, unfortunately, you are dead. Okay, right? And again, coming back to our own example where you have been a part of Big Basket. I mean, Big Basket could not have been where it is today if it was not for growth. Yes, ideally, all of us want very profitable, high unit economics, very sustainable growth. But that choice is not with me. When we were very happy with Big Basket Series A, Series B fundraising, suddenly Flipkart decides they want to enter into grocery. Okay. Then Flipkart enters, then they withdraw faster than they entered because it doesn't work like that. Then Amazon enters. Amazon enters, spends lots of money. After that, we heave a sigh of relief. Then Grofers come in. Then Grofers became Blinkit. Then publicly listed Zomato acquires Blinkit. So it is not a very easy decision. I want to grow sustainably, but unless I grow, I'm dead. And before I can even take a deep breath, there is between Blinkit, between Zepto, between Zomato, between this, everybody can. So the short answer is growth is a must. When you are in early stage, ensure that you are not growing too early by acquiring market share. Don't burn your investor money to acquire market share because that growth is bad growth. That growth will stop the moment you stop wasting investor money in acquiring market share. What a lot of companies, the mistake they do, the bad growth or mistake they do is because their next round of valuation is dependent upon showing some growth metrics, they end up doing television ads, and you mentioned some of them like housing companies, for example, doing ads to acquire market share or show numbers to grow before fixing their basics in order. Okay, right? Fix the basics in order and grow. But again, I'm not the right person. I've done enough mistakes.
So I think it all boils down to the founder, the skill sets, their passion, and of course the idea and the market, because that assessment is important to figure out whether it's going to be really be touching more people or rather touching really large scale, at large scale, is it going to be, this problem is going to be solved at large scale? These are the three things I would particularly look for while investing.
Great. Changing gears once again a little bit. If you look at companies that are publicly listed on NSE, for instance, 1,300 plus companies are there. And in most of the companies, average shareholding of promoters is about 45%. And if you look at startups, for instance, that have raised a lot of money, holdings of promoters or founders tends to get to single digit 5%. So how would you think about, holding equity, continue to take ownership, and building companies where promoters retain a significant stake even after they exit, by the time they reach IPO? How should founders think about this question?
This is a very difficult question, as well as difficult one to practically deal with, especially the initial days of building, when you are at different stages of needing money. This is the times when we also fall into the pitfalls of, there could be different league and sources from where money comes from. And that's a time when we have this tendency to actually dilute more and more. And that's where, by the time of exit, by the time of next rounds, and by the time you have built a great business and built a great business model, you find that the founder promoter share is down to some single digits probably, right? And the investors will be holding the majority of that. And this is a huge pitfall. If you ask me from a practical scenario versus a theoretical scenario, theoretically, we should definitely be guarded about, we should know the value of what we are building. At every point, if we know the value, we will be in a position to, with all kind of fierceness, guard the equity that we have. We value the equity very dearly. But at the same time, there are times wherein survive and see the next day versus, do you want to stand a chance to see the next day versus you take the money at whatever dilution and move forward to the next level. That's the practical challenge, and you should never get into this practical challenge many times in the life of or in your journey. And the way to do it is that at any point in time when you're raising capital, always ensure this could be the last raise you could have till the time I get to a stage where I can stand on my own feet. And that's one formula, if you keep in mind, we would be in a position to run faster, create urgency, and even get to a framework where to invest to get where you want to. And that's one thought I would leave you with.
So Ganesh, one learning, for instance, one big mistake you might have made, I think you alluded to that a little bit. What are one or two big mistakes you may have made in your journey, and what were some lessons that you learned?
Yeah, but before that, I just want to add one thing on your previous question, because it's very close to the heart. I started my entrepreneurship journey 33 years back, okay, right? And 4 Greenfield Ventures as founder and CEO. I started, ran Greenfield and sold it. Reasonable outcome. 2 of them had venture capital money, so we diluted early and all that stuff. 2 of them did not have venture capital money, so we did not dilute early. It was owned between me and co-founders. Statistically, I can tell you, I made more money out of those 2 where I diluted early, take venture capital money. Because remember this, 100% of 0 is 0. 100% of 0 is 0. Okay? 1% of 1,000 is 10. I would rather have 10 than 0. Okay, right? So it's not a straight answer. Okay, right? I agree with what she mentioned, that fundamental job as the founder for you is to ensure the company survives. If the company shuts down, company never shuts down because the entrepreneur or a founder has got less equity. None of us is going to go and say, oh my God, I'm going to run away from here because I don't have 30%, I don't have 5%. We are not made that way. We are extremely passionate about this particular business. So company shuts down not because founder has got low equity or has got single digit equity. Company shuts down because the last 1,000 rupees to pay the vendor, pay the employee does not exist. And that can be solved by raising money. So my advice, anytime you can go and raise money at any valuation, by all means, unless you are profitable, unless you are churning out money, go and raise money. Don't optimize for dilution. Okay, right? One. Now coming back to
Next question.
Okay, right. So that may be contrary view, but you will never suffer. You are not going to worry. You will worry a lot. You will lose all the hair like I have lost if you shut down the company and if you don't have money to pay the vendor. On the other question of mistakes are too many. If I start on my mistakes, I'll take today and entire tomorrow to talk about mistakes. So fundamentally as entrepreneurs, what we look at is not how many mistakes you made, how many goals you scored, how many times you hit the goal. In a football game, I'm in Kerala, so I'll talk about football. In a football game, you win not by the percentage of shots you hit into the goal, not by the percentage, by number of shots you hit. If I try, I might have done 80%. Doesn't matter. How many goals I scored is what matters. My mistakes are many. One that really stands out, which really I think made the biggest difference for me is my first company was IT&T. It was into hardware computer maintenance. It was the same time when Infosys had started, Wipro had started. We were doing extremely tough job, working very hard on hardware maintenance services. If we had even just looked outside to the world, look outside what's happening, instead of focusing inside, we could have easily done software. And I'm talking about 1990. If we had just put 10% of our effort on software, we would have been 1,000 times more valuable. So if you ask me, my biggest regret is not focusing on software when you could have done hardware. All that it required for me to do as founder, as CEO, was to keep a slight eye open on what's happening outside the world. What's happening in Bangalore, we were in Delhi at that time, was so busy trying to handle day-to-day problems that we didn't do it.
Awesome. So back again, once again, Ganesh, for you, which is in 2023 and late 22 also, several high-profile, high-growth, startups began to show governance challenges, began to implode a little bit. What do you think results in founders doing things which result in poor governance and eventually, the company itself beginning to implode? Why are they under pressure? What actually makes them do these kind of things?
Yeah, good question. I have lost money in couple of them that that are public in that sense. No, I think it is just, in my opinion, it is immaturity. They are not bad people. They are immature people. They are young. Okay, right? Perhaps because they are young. What we lack is a robust governance system in startup. One of the mistakes that we do, and me included, is we hide under the garb of a startup, okay, and say startup means no systems, no processes, no accountability. That actually is not true. Every startup, after it reaches certain number of employees, say 100 or 200, or certain number of customers, say 1,000, or it raises certain money, say 100 crores, becomes like a publicly listed company. Should be governed with independent board, independent directors, with Big Four audit, systems and processes. You cannot hide under the garb. That's one. Two, mentors and independent board members, especially when you have young founders who have not seen it before, is a must. I think immaturity is what it is. They are not bad at heart. They're just immature. They want to show results. They want to raise extra money. It's very, very, very sad. But the good part, even though it has come out in the media, which is good because it has shown the mirror to all of us, the percentage of such incidences are very, very minuscule. That's a good part. The bad part, it does show the mirror for all of us to learn, including me, how to insist on governance. When investors invest money, they put 1,000 clauses. Why don't they put one more clause saying that independent audit, systems and process, independent board members? That's my pet peeve. People like yourself who have been in the system should be asked to be as independent directors on the board where you're not an investor. Today what's happening in startup is, who is the board? The founders are the board, who are the management, or the investors who have got their money inside of the board. So nobody wants to take care of the employees, customers, system at large, because they have got a fiduciary or their own interest into it. That's my...
Awesome. So Deena, if you just look at startups that have got built in the last several years, which have become really very big, many of them really ended up addressing problems and inconveniences of the top 50 to 100 million consumers in the socio-economic pyramid. Now, building products and businesses for solving problems of the next 400, 500 million Indians is a different kettle of fish altogether. They are people who are time-rich and money-poor customers, not willing to pay, do not have enough money to pay. So what are the challenges for building businesses that solve problems of customers who really don't have paying capacity? Yet the market is out there and the top market is already beginning to saturate. How do you build business effectively for the next 400, 500 million Indians?
So in fact, in India currently, what you see is that the top part of the solution building, a lot of it has got saturated right now, and there are fewer companies. But for the Bharat, the kind of solutions and the kind of products which has gone out are very, very few right now. There are good part is last 2 to 3 years, if you see, especially accelerated by the pandemic. This has become a focus sector. And that's where historically it has been also been a myth that they don't pay at all. But you go with the right solution to them, they are willing to pay. Might not be the kind of money that you can get from the top pyramid, but the 80-20 principle still applies there. The kind of volume, sheer volume we have, the need of these people, and if you solve for real problems, there is money to be made. But at the same time, caution you about the challenges you need to keep in mind. One, the fragmented India. What Ganesh was just mentioning about the distribution, because the distribution for the Bharat is still not something which is uniquely solved for yet. But thanks to all the government public goods and the infrastructure which is being built, right from ONDC to the health stack to the entire India stack, trust me, it has never has been a time where we can go ahead and build for Bharat. Also crack the distribution, and that's where GTM, vernacular angle of it, the different flavors and different ways in which you have to capture the market there. But if we crack that, there is money there. So it is a myth that they don't pay. So please go ahead and build. This is the right time to build for Bharat.
Great, very inspiring. Ganesh, any point of view on that?
No, I agree with her.
It's very easy. So I think I just have one more question probably for both of you. And this is about a slew of IPOs that have happened in the last year. And this year also we are beginning to see some IPOs. So the question really is about what is the right time for a startup to think of listing. And startups that listed last year or the year before towards the end, many of them collapsed when post-listing, and early stage retail investors also lost a lot of money. So how would you think about listing and going public? At what stage? What should they think of? What factors should they keep in mind? Is a question I just want to explore with you. And I have a follow-on question, but I'd love to hear from both of you on this.
This is a tough question. You please answer. Okay, right? I'll take the easier one.
So thinking from first principles, and when we are thinking of probably, when should open go public, for example, we are definitely actively thinking about it, and that's any entrepreneur's dream for that matter, having a company which goes public, right? So we have seen good part is India, unlike 5 years before, the startups and the SME IPOs, it's becoming extremely palatable right now. The good part is that there are successful IPOs which are coming up. And there have been crashes, I agree. There have been the initial listings which has happened, which is almost 50% to even at the lowest point, 50 to 60% and even more wiped out in the market. But if you see the current year, some of the earlier listed, some things which we have wrote off telling this is not going to work and market doesn't know how to value all of that, they started coming up. And today, for example, companies like the Zomato shares, it's almost at the, back to the listing, IPO price, and all of them are equally bullish about that, touching another 40 to 50% higher in the short term itself, which is very encouraging to see. But at the same time is IPO, the good part, what I'm again mentioning is that India and the Indian market is now ready for startups and the early stage IPOs. But in terms of the preparedness, this is where governance come into picture, the way in which most of the companies going IPO is not the biggest issue, but after that, how do you behave? Are you prepared from a timing perspective? Do you have the growth story properly done? In terms of, the growth is predictable. You know what all levers to be done for showing that growth to go into the market. Every quarterly, how do you predict it with accuracy? Is your governance and compliance in such a shape that you are bang on with going with the quarterly closing and the results and the announcements part of it? Governance, where you stand. Again, compliance. These are the areas, the preparedness has to happen at least 2 to 3 years earlier. So IPO is always a backworking. If you go to the market without being prepared, with growth, very good revenue numbers and profitability, or at least a good path to profitability with a decent margin, not like the 10% margin when you go at the initial stage, but at least, something which is predictable growing. There is no way, you cannot expect wonders. The market is going to just value and do wonders for you. But with all this preparedness, if you're going into the market, today's results are very encouraging. And most of the companies that we wrote off also today started showing great progress. So it is good news for everyone who is building right now. Plan it for 5 to 6 years if I have to go public, if not earlier. 3 years, minimum 2 to 3 years of preparedness you would require from all angles, and behave like a public company before you even list. And that's the only thing I would recommend.
Think and behave like a public company before you become a public company. Wonderful advice. Ganesh, any perspectives?
No, I think she has put it very nicely. I'll go with,
Okay.
I'll go with whatever she said.
You don't need to comment every time. Wonderful. Okay. So one last question. I think we are reaching the end of our time. One last question to both of you. Just keep it to 2 sentences. So you're very young founders here, building businesses for Bharat, many of them non-VC fundable, but amazing set of entrepreneurs, very passionately solving a problem. And this is what we need. We need people who take up entrepreneurship and create jobs. What would be your advice to these kind of founders? Just in 2-3 lines, max.
Yeah, no, so I think I really wish I was not a bald old man sitting here giving gyan to you people. I wish I was young like you, sitting on the other side, listening to Gyan. Because this is the best time to be young, to be able to build businesses in India. The cost of failure is the lowest that it has ever been. Our previous generation, my parent generation, were looking for government job security. My generation looked for corporate jobs so that we could buy a 2-bedroom flat and be able
Ganesh,
to provide...
we're running out of time. Just last one
decent,
line.
decent education. But this is, cost of failure is low, opportunity is high, all the ducks are aligned. You have startup, accelerator, incubator, angel investors, government, Kerala Startup Mission, everybody rooting for you. Go ahead, take the risk and build a business.
Wonderful, inspiring words, absolutely. Deena, your one last line.
That was straight from the heart, and I'll also say follow your passion. And the very fact that today you are here and you're a part of this ecosystem, which is a wonderful startup ecosystem, you're meant to be. And just go build for Bharat, right place at the right time, go rock it.
Thank you, wonderful audience. Thank you all. And Ganesh and Deena, thanks a lot.